everything I just talked about, there's a use of credit for those to function. And when credit breaks, everything will stop. Your entire way of life, our world as we know it, will completely stop without credit. And credit is based on confidence. And with what's coming and what's going to happen with, derivative contracts in the couple quadrillion breaking, there's not going to be anything left standing except for gold and silver as money. There will be no money other than gold or silver that has not bankrupt, because that's the problem with fiat currencies. They're credit based, and when credit fails, so will the fiat currencies.
Renowned analyst Bill Holter highlights a critical vulnerability in our modern financial system, which relies heavily on credit. Virtually every facet of life, from the housing market to the supply chain of everyday goods like bread, is intertwined with credit. In housing, for instance, inflated prices driven by bidding wars have created an unstable bubble. When fiat currencies lose value due to inflation, gold typically retains or increases its value. As J.P. Morgan famously said in 1912, "Gold is money, everything else is credit." Back then, currencies like the US dollar were backed by gold, giving paper money a tangible promise of value. Morgan's words still echo today. Unless you hold gold, you don't hold real money, only a promise represented by paper. This perspective becomes even more urgent with the looming BRICS summit, where leading global economies are expected to discuss their intent to reduce reliance on the US dollar and the Western financial system. If these nations continue to reject the dollar, it could significantly increase pressure on an already fragile financial infrastructure. In a recent move, Saudi Arabia announced its involvement in Project M-Bridge, which explores a multi-central bank digital currency, CBDC platform shared among participating central and commercial banks. When trust in the system collapses, so does credit, and with it, the entire structure of fiat currency. Currencies that are essentially promises rather than assets. Bill warns that only tangible assets like gold and silver, which have intrinsic value, will endure in such a scenario. Unlike fiat currencies, gold and silver are rooted in scarcity and historical stability, providing a safe haven during financial upheaval. Bill Holter's message is a clear call to action. Preparation must happen now, before the full impact of a credit collapse strikes. In the aftermath, only those who hold real assets like gold and silver will remain secure in a crumbling financial system. We will present clips from Holter's latest interview with Liberty and Finance. Please share and like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thank you, and enjoy the video.
From an asset side, we live in fairy tale land. I mean, if you bought a house 5 years ago for $250,000 and now it's 500, 600, 700,000, do you really believe that's on solid footing? And there's people, that have bought houses over the last year, 2 years. I mean, last year, the year before, what did you hear about? You heard about bidding wars. Somebody offering a house for 500,000 and it ultimately was bid up to 625,000 within 2 days of coming on the market. It was a bubble. It's going to pop. And as the economy deepens into a recession, you're going to see more layoffs. You're already seeing layoffs. You're going to see people that cannot pay their mortgages. Houses are going to go into foreclosure, and the bidding in foreclosure, are simply fractions of what the current prices. I'm not going to say values, but what the current prices are. And that $500,000 house 5 years ago, it's probably going to change hands at $300,000 or $400,000 at foreclosure. So it wipes out all equity, because most people don't put down more than 10%. Some put down 20%, but all of that is going to be chewed up. Somebody has got to eat those losses, and the banks hold some of the mortgages. The mortgages are held by pensions. Pensions are going to eat the losses. And I'm just talking about housing now. Look at commercial real estate. Look at high-rise office buildings. Look at hotels. I mean, there was, and I can't remember where it was. I posted it about 2 weeks ago. There was an office building, and I believe it was in New York City, that actually just changed hands at about 6% of what it traded at in 2006. And the losses were about $200 million. Somebody eats that. That doesn't just get swept under a rug, and it's somebody's balance sheet is ultimately going to reflect that $200 million loss. And you're talking about, call it $1 trillion market just in commercial alone. So where we stood 15 months ago when those banks went under, I mean, we're on much less solid ground. I mean, the whole system is literally trying to stand in quicksand. Everything I just talked about, there's a use of credit for those to function. And when credit breaks, everything will stop. Your entire way of life, our world as we know it, will completely stop without credit. And credit is based on confidence. And with what's coming and what's going to happen with, derivative contracts in the, couple quadrillion breaking, there's not going to be anything left standing except for gold and silver as money. There will be no money other than gold or silver that has not bankrupted, because that's the problem with fiat currencies. They're credit based, and when credit fails.
Despite highlighting the value of gold and silver, Bill also draws attention to a significant but often underappreciated risk in investing: holding stocks in a margin account. Recent developments in the market have only heightened the relevance of this issue. Many investors believe that they maintain full control over their shares once they acquire them. However, this assumption is incorrect in a margin account. When stocks are deposited, brokerage firms can lend them out almost immediately. Recent market turbulence, driven by inflation concerns, geopolitical instability, and interest rate hikes, has intensified the risks associated with margin trading. During the 2022 and 2023 sell-offs, margin traders were particularly vulnerable as brokerage firms swiftly liquidated positions to recover loans, often selling shares at a loss. These actions exacerbated individual losses and contributed to market instability, prompting discussions among regulators about potential reforms to margin lending practices. Margin calls remain a looming threat amid economic uncertainty, with central banks signaling more rate hikes to combat inflation. As stock prices fluctuate, margin traders may face sudden calls to deposit additional funds or risk having their shares sold to cover shortfalls.
A margin account, what that does, it allows the brokerage house to lend your securities. So you put stocks in today, and by tomorrow morning, they're already lent out. You have to ask yourself, how is it possible that these major Wall Street firms have huge office buildings, they fly around in private jets, they go everywhere in limos? Where did that money come from? Well, it didn't come from the $7.95 that they charge you for whether it's a $10,000, $100,000, million, or $10 million trade. It's a flat fee of $7.95. There's no way they're making money on that. The way they're making money is by lending your securities out. So if you have a margin call, or if you have a margin account, that's a huge mistake, because your shares are not even in that account the day after you deposit them. Even a cash account, holding in a cash account, you will be bailed in. Again, watch The Great Taking. I just posted it again on my site. I think it was Saturday or maybe yesterday. Spend the hour to watch that, because all of your assets, when this thing busts, all of your assets are going to be taken over by whoever the institution is to save their own bacon, not you. And just to illustrate, so let's say that you got to put 50% up to buy 50% is your money, 50% is margin. So you got $100 stock, you put up $50, and they lend you $50. And the stock, instead of going up, if it goes up to 15, you doubled your money, because you've only got 5 in it. If it drops from 10 or from whatever, from 10 to 5, you've lost all your money. and you're required to keep, I believe it's 30% margin. It might be higher. I don't know where the numbers are now, but when I was a broker, you had to have at least 30% margin. And if you dipped below that, then you would get a margin call. So if the stock went from 10 to $7.99, you had a margin call from $8 down because your margin, what you put up, was not sufficient to cover it. It's a double-edged sword. It's great when prices go up, and it's disastrous when prices go down, because when you get a margin call and you can't meet it, your firm is going to dump it on the market and get whatever price they can, because they're protecting themselves. They lent you money. They're protecting their loan. So you have absolutely no choice, no say whatsoever as to how your position gets sold. It will just get dumped, and you're not going to get the best price. You're going to get knocked out of your position and at a bad price.
With growing uncertainty in global markets, many investors are turning to gold and silver as safer alternatives to credit-based assets. For instance, during the 2023 US banking crisis, gold prices surged as investors sought a safe haven amid regional bank liquidity issues. Silver also rose, driven by industrial demand and investor sentiment. With credit markets growing unpredictably and central banks tightening policies, many view precious metals as a stable foundation in uncertain times. Share your thoughts on Bill's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.